Anyway, the other thing for the government right now is banks. Who controls interest rates in this country? Doesn't seem to be the Reserve Bank. With Westpac's unilateral decision yesterday to raise interest rates on mortgages. So the Prime Minister was asked about this while I was out throwing a rugby ball today.
They have to justify in this environment, when people are really feeling it, why they believe they need to clip that ticket a little harder when people in Australia and their customers, I think, are doing it tough. If you don't like what Westpac's done, go to another bank. Because competition is the key to a more competitive and a stronger and more accountable banking system.
He's right about that. Competition is the key. But as we all know, it's not that easy to move banks. And trying to find out where all your various payments have gone to. In many ways, a lot of people, I think, just suck it up and pay the money. That's sad, because it just shows the system doesn't work properly. But a man who, very early in the piece, called that the banks would have to ultimately make this decision, raise interest rates. And he'll explain also why Westpac is not alone, that the rest of the banking system is in exactly the same situation, is Martin North from Digital Finance Analytics. He's on the line. Many thanks for your time, Martin.
Hello.
This goes back to a statement that Westpac made on Friday, largely overlooked. You picked it up pretty quickly, and it's all about Westpac and its margins, isn't it?
Yes, it is. Their margins dropped significantly, and they blamed three things, but the critical one was the international funding costs, which took quite a lot of margin out, and, of course, the switch from interest-only to principal and interest loans that they are in the middle of because of the recent changes there. Those two things are really biting the margin at Westpac. So they said they had no choice but to lift the rates for the back book of mortgages. In other words, everybody's got a mortgage with them, whether it's a principal, an interest, or interest-only loan, whether it's investor or owner-occupier, they're going up.
And as the Prime Minister says, everybody is free to move to a different bank or a different lender if they wish to. It's not that easy, we know, because also Westpac's dilemma with its margins being squeezed because the cost of finance here in Australia and overseas is rising. They're not alone in sharing that pain.
No, that's right. So pretty much all of the major banks who still get a lot of their funding from the overseas capital markets are all experiencing this same rise. And you can basically trace it right the way back to the US Fed and the lift of the rates in the US. So everybody in the sort of the industry knows that the big banks are all facing with the same pressures. The other problem is that because of lending tightening, in other words, the rules are much more difficult now, there are many people locked into these higher rate loans who cannot now refinance away from them because the lending standards are too tight. So they are actually mortgage prisoners.
So mortgage prisoners is what some people might be. We'll try and get some of those on the line tonight on 131873. Now, given the fact that you've got interest rates rising because banks are being squeezed, normally when interest rates rise, housing markets rise and central banks respond to those rising markets and also to an improving economy by raising interest rates. Our central bank did not do that. It sat on its hands. Now the banks are increasing rates at a time when our two major capital city housing markets are falling and falling very quickly. Rising interest rates surely will only accelerate the fall in those housing markets and raise the prospect of increasing delinquent debts inside the banks.
Yes, Ross, this is a very significant change in the marketplace. So effectively, it's being driven by tighter credit. So the rules were way too loose for years. You know, the Royal Commission highlighted that, and we've seen this in our own work here, that people were getting loans they should never have got in the first place. So basically, that drove prices way higher than they should ever have been, and people are sitting on very large mortgages. Suddenly, it's all tightening. Investors are moving out because effectively the rental returns just aren't there, and the capital gains is no longer there. And now we're seeing price falls accelerating, and I know that the real estate sector is saying, oh, it's just a temporary blip, it'll recover. I'm much more sceptical than that. I believe that we are in a very significant sliding phase, and as we go into next year, I think prices will move down even further.
Okay, for those people who have had properties for a long time, they'll be fine. They will have built equity in their properties and probably got themselves well ahead with their loans. For people who have got secure jobs, generally they'll be okay. They can guts their way through. People who are at the margin, people who have more recently bought, taken on big mortgages, and whose jobs might be more at risk if there is a downturn in the economy, they're the people who are vulnerable, and those areas areas that have jumped most? I'm thinking about inner suburbs in Melbourne and Sydney, particularly some of the inner western suburbs in Sydney. These are the ones that are potentially vulnerable if unemployment starts to bite in some of those areas.
Well, yes, there are hot spots in a number of areas. Of course, the problem is that cost of living are rising and incomes aren't. So effectively, there's no get out of jail card there. And so you're right. People with very large mortgages who bought relatively recently are already seeing the value of their properties moving into what's called negative equity. In other words, if they sold, they wouldn't be able to repay the mortgage.
The danger is here, Martin, that it could almost become a bit of a spiral, because if you suddenly got rising interest rates, putting pressure on households and property values, they start to go down. And as a result, what happens is the banks aren't selling as many mortgages. It really could start to really create a bit of momentum, and that is not a good thing for the economy. It's not a good thing for households, not a good thing for banks, not a good thing for government.
No, its sentiment is fundamentally driving it. So just as everybody was, enthusiastic about property on the way up, the risk is that everybody now goes the other way and says, "Oh, property is a terrible bet." The truth is there's still some value there, and you always need somewhere to live. But remember, our home prices are 30 to 40% overvalued relative to pretty much every ratio that you can ever think of. And there's another 200,000 units coming into the market over the next 12 months. So effectively, there's, I think, only one way that prices can go down. And the difficulty now is how do we manage that? And the more that rates go up, be it the Reserve Bank or be it out of cycle, it just puts more pressure on, and therefore prices will slide even further.
There you go, Martin North from Digital Finance Analytics. That's a pretty sobering outlook for the housing market, but you'd have to say it makes an awful lot of common sense that is the result of having prices move so quickly over such a long period of time. The lending standards at that time not being potentially what they were. And as banks try and tighten up now, guess what? They only compound some of the falls that are already in the marketplace. Martin North from Digital Finance Analytics. Always good to have you in the program, Martin.
Good to talk to you.